Today we are unpacking the 2026-27 federal budget. It's been labeled a once-in-a-generation fiscal pivot, and for once, the hyperbole might actually be justified. We aren't just looking at minor tweaks to the tax brackets this year, we are looking at a fundamental redesign of how wealth and investment are treated in the Australian economy. Let's dive into the numbers and the logic behind these seismic shifts. You can't understand the why of this budget without looking at the where. We are operating in a global environment of extreme volatility. Supply chain disruptions and energy price spikes, modeled by Treasury at a worst-case scenario of $200 per barrel of oil, have forced the government's hand. This budget is designed to be contractionary enough to cool inflation without tipping a fragile economy into a technical recession. Here is the reality check. Inflation is stubborn, peaking at 5.0% this June. This is higher for longer than many anticipated. Consequently, GDP growth is forecast to slow to a subpar 1.75%. What does this mean for us? It means the easy money era is officially in the rearview mirror. The government is signaling that it cannot rely on growth alone to repair the bottom line. It must now find structural savings and new revenue streams, which brings us to the controversial tax reforms later in this deck. On the surface, the numbers look slightly better than the December updates, a $28.3 billion deficit for the current year. However, the medium-term outlook is sobering. Gross debt is on a trajectory to surpass the $1 trillion mark this year, eventually peaking at nearly 36% of GDP by 2029. The Treasurer is walking a tightrope, trying to pay down debt while providing enough of a cost-of-living shield to prevent a collapse in consumer confidence. The $45 billion in projected savings over the forward estimates is largely predicated on the reforms to the NDIS and the taxation of passive income. Now, let's talk about the Big Three. If there is one thing you take away from today, let it be this: the government is moving away from asset-based tax concessions. 1. CGT, moving from a flat discount to an indexation model. 2. Negative gearing, shifting from a tax minimization tool for established property to a supply stimulus tool for new builds. 3. Trusts, closing the gap on income splitting with a 30% floor. These aren't just revenue raises, they are an attempt to realign the tax system toward tax neutrality, taxing the activity, not the entity or the asset type. The headline act is the abolition of the 50% CGT discount. From July 2027, we return to a PRE 1999 style indexation model. The logic: you should only be taxed on the real gain above inflation, but you shouldn't get a 50% gift just for holding an asset for 12 months. The math for your clients will now look like this: taxable gain equals sale price minus cost base times indexation factor. Crucially, there is a 30% minimum tax rate on these gains to ensure high-wealth individuals can't index their way out of a significant contribution. Existing assets retain the discount for gains accrued up to the start date, but there is no step-up or revaluation allowed, which will make for some complex accounting in the 2027 transition year. Is the most politically charged part of this budget. To address the supply crisis, negative gearing is being restricted. If you buy an existing home after today, the 12th of May 2026, your interest and maintenance losses can only be offset against rental income or residential capital gains. You can no longer use them to reduce the tax on your salary. However, if you build a new home, the old rules apply. You get full deductibility in a choice: the 50% CGT discount or the new indexation model. The government is effectively saying, we don't want you trading old houses with each other, we want you building new ones. To sweeten the pill of the investment tax hikes, there is relief for workers. The 15% and 14% tax rate cuts are locked in for the next 2 years. Furthermore, we see the introduction of the Working Australians Tax Offset, WATO. Worth $250, it effectively acts like a $1,800 increase in the tax-free threshold. And for the accountants in the room, the new $1,000 standard deduction for work-related expenses is a double-edged sword. It simplifies things for millions of taxpayers, but it likely reduces the need for basic compliance advice for the no receipts crowd. For small business, the theme is certainty. The $20,000 instant asset write-off is finally being made permanent. No more year-by-year extensions. We also see the reintroduction of loss carryback rules. This is a massive win for businesses that were profitable during the post-COVID boom but are now facing a downturn. They can essentially get a refund on taxes paid in the previous 2 years to help with current year cash flow. How is the government paying for all this? The NDIS is the primary target. By tightening eligibility and cracking down on over-servicing, they expect to save $35 billion. On the innovation front, the R&D tax incentive is being boosted to a 50% offset, but there's a catch: it's for hard science only. The era of claiming R&D for market research or literature reviews is over. They want tangible, technical innovation. Timing is everything. Grandfathering for negative gearing starts now. July 2026, Stage 3 tax cuts, Phase 2, kick in. July 2027, this is D-Day for CGT and negative gearing reforms. July 2028, the 30% trust tax begins. We have a 12-month window to review client portfolios and determine if disposals should be accelerated or if investment structures need to be wound up before the 2027 changes. This budget represents a clear ideological shift. It prioritizes housing supply over property speculation and labor over capital gains. For us, it means a lot of work in the transition phase. I'll now open the floor to questions on specific modeling or implementation dates. Thank you.